Today, we're going to talk about how to invest in stocks and how to set up a good portfolio for beginners. It is very important that you stick around until the end of this video today, because I will share with you what most people do wrong when they start investing. So let's get into it. Welcome back to the official Finflix channel. If you like this kind of content, like and subscribe. The first question which many of you might ask is why invest at all? Well, if you have some extra money, investing can be one of the best ways to grow it. The main way is by making sure you resaving a portion of your income and investing it over time. You can then use compounding to make more money with relatively little effort. All you need is discipline and patience. It's also really good to remember that investing doesn't mean taking big risks. There are low-risk investments available for people with smaller budgets who want to invest but are scared of losing their money. Don't worry, you don't need a lot of money to start investing, and you don't need to be an expert either. If you are just starting out, there are plenty of resources online or in libraries where you can learn about the stock market and the different types of investments before diving in head first. Now let's move on to the next step. Understand the basics. Before you invest any money, it is essential to understand the basics of investing and the different types of investments available to you. For example, stocks, bonds, mutual funds, and exchange-traded funds. Stocks represent ownership in a company. So when you buy a stock, you become a shareholder of that company. Bonds are loans that you make to governments or corporations in exchange for regular interest payments. Mutual funds and ETFs are investment vehicles that pool money from multiple investors to invest in a wide range of securities. It's also important to understand the risks involved in each type of investment and the potential returns you can expect to see. It is wise to research and compare different investment options before deciding which ones are right for you. Many brokers offer educational resources on their websites or apps that can help you get up to speed quickly. Once you understand the basics, it's time to open a brokerage account. A brokerage account allows you to buy and sell investments such as stocks and bonds. Many online brokers offer commission-free trading on stocks and ETFs, which can save you money on trading fees. When choosing a broker, it's important to consider factors like ease of use, customer support, and the range of investment options offered. Most brokers have minimum requirements for opening an account. Some may require a deposit of $500 or more, while others allow you to open an account with just $100 or less. Once you've chosen a broker and opened an account, you can start investing. The next step is to build your portfolio. A good portfolio is one that meets your financial needs and aligns with your investment goals. The first thing you need to do is determine your risk tolerance. This refers to the amount of risk you're willing to take on in your investments. Generally, the higher the potential return, the higher the risk. Consider your age, income, and financial obligations when assessing your risk tolerance. Next, identify your investment goals. Are you saving for retirement, a down payment on a house, or something else? Knowing your goals will help you decide how long you can invest and how much money you can allocate to different investments. Finally, diversify your portfolio. Diversification is key to managing risk and maximizing returns. It involves spreading your investments across different asset classes, industries, and geographic regions. By diversifying, you can reduce the impact of any single investment on your overall portfolio. A good starting point for a beginner investor is a low-cost index fund that tracks the overall stock market. These funds typically have a low expense ratio, which is the fee the fund charges to manage itself. They also provide instant diversification, meaning you'll own a small piece of every company in the index, which can help mitigate risk. Moving on to the next step, understanding your own risk. As we mentioned earlier, it's crucial to understand your risk tolerance. However, in addition to that, you should also assess the risks associated with specific investments. Let's take Tesla stock, for example. It's a highly volatile stock, meaning its price can fluctuate significantly in a short period. If you invest in Tesla and the stock price drops, you could lose a lot of money. On the other hand, if you invest in a low-cost index fund like the S&P 500, the ups and downs of individual stocks will be averaged out, and you will be able to ride out any short-term volatility. While the S&P 500 may not deliver the same high returns as a stock like Tesla, it's a much safer bet for beginner investors. Another important aspect of managing risk is to never put all your eggs in one basket. This means you shouldn't invest all your money in a single stock or industry. Instead, you should diversify your portfolio across different asset classes, industries, and geographic regions. For example, if you invest in a few solid growth stocks and a couple of index funds, you'll be well diversified and less likely to lose money. Now let's move on to how to pick stocks without guessing. Picking stocks without guessing involves doing thorough research and due diligence. One great resource is a free stock analysis website. Simply enter a company name or ticker symbol into the search bar, and you will get a comprehensive breakdown of the company's financials. You can access key data points like revenue, earnings, and cash flow, as well as analyst ratings and price targets. This website also offers a stock screener tool, allowing you to filter companies based on various criteria, such as industry, market cap, and financial ratios. For example, if you're interested in investing in technology companies with a high growth potential, you can use the screener to find stocks that meet your criteria. Additionally, TipRanks also provides a news section where you can stay up to date on the latest developments affecting public companies. This can help you make informed investment decisions based on current events. Next, setting goals and sticking to a plan. Setting clear goals is essential to successful investing. Without a plan, you're unlikely to stay motivated and disciplined over the long term. Your goals should be specific, measurable, achievable, relevant, and time-bound. For example, instead of saying, "I want to make a lot of money in the stock market," say, "I want to earn a 12% annual return on my investments over the next 5 years." Once you've set your goals, it's time to develop a plan to achieve them. This should include a written investment strategy outlining your asset allocation, investment style, and risk tolerance. Regularly review your portfolio and make adjustments as needed. This may involve rebalancing your asset allocation or adding new investments to your portfolio. It's also important to have a long-term perspective and avoid making impulsive decisions based on short-term market fluctuations. We've made it to the final tip: avoiding common mistakes. One of the biggest mistakes beginner investors make is trying to time the market. This involves buying and selling investments based on predictions about future market conditions. However, studies have shown that it's impossible to consistently time the market. Another mistake is investing in things you don't understand. Many investors get caught up in the hype of a hot stock or investment, invest in it without fully understanding the underlying business or technology. This can lead to poor investment decisions and potential losses. To avoid this, take the time to thoroughly research any investment before putting your money into it. It's also important to avoid emotional investing. This is when investors make decisions based on their feelings rather than logic and reason. For example, fear of missing out or FOMO can cause you to invest in risky assets, while greed can make you hold on to losing investments for too long. Avoid these pitfalls by sticking to your investment plan and only investing in things you understand. So now you know how to invest in stocks and how to set up a good portfolio. We hope this has been helpful and you feel ready to start your investment journey. Remember, slow and steady wins the race. Don't try to get rich quick by investing in risky assets or making impulsive decisions. Instead, focus on building a diversified portfolio of solid investments and stick to your plan over the long term. Long-term strategies usually outperform short-term strategies. Remember, it's not how much in the market, it's how long you are in the market that matters. The market in the short term is always up and down, but since the creation of the stock market, it has only been going up. Remember not to panic sell when prices fall. Look at it as a great time to buy stocks on sale. This would fall under the principle of dollar cost averaging. If you would like me to make a video about that or other strategies on stocks, let me know in the comment section below. Thanks for watching the official Finflix channel. Good luck and happy investing. If you liked this video, don't forget to like, subscribe, and hit the notification bell so you don't miss any valuable content in the future.